What's up, guys? Welcome to another Market Radar podcast. It is November 19th when we record this. It's been pretty slow this week. Not much happened, honestly. I'm pretty sure we closed almost right where the week started. Let's go through the year-to-date performances. SPY down 17.1%. QQQ down 29.09%. IWM down 18.46%. DIA down 7.74%. Our system DDAP trends are still bearish trend on all of these. System continues to print stagflation. We did see a rise in inflationary odds once again. Also a rise in system confidence in the inflationary odds, but still way too low to consider a regime flip. So we are still in stagflation. Also, it's not us that's deciding to be in stagflation. It's all the model algorithm that's doing this. System strength is low, so we did not switch to inflation. So that's why we are in stagflation.
Yeah. So one quick thing, the Dow futures did close in bullish trend. So
Oh,
so I want
okay.
to clarify, it's all the other major indexes are bearish except the Dow futures. So it's something to watch there, but mostly all the other indices are still bearish trend.
Yeah, we'll see. We'll see if we can get some follow through from the other ones, following through with Dow all going bullish trend, and see if we can get a risk on pivot here, which would be nice. We are really itching to get out of this stagflation. It's been pretty brutal, longest one that we've had recorded. But
Yeah.
we're not going to front
Definitely, it
run it.
definitely sucks. It definitely sucks. I mean, it's a lot of just agonizing patience that's required. Otherwise, um, you end up doing things that will hurt you in the long term or get confused on biases that don't work over time, and you end up putting positions on and getting emotionally attached to them. And when the time comes to act, your judgment is clouded. So that's
Yeah.
something
Keep
not
in
to
mind,
mention.
when you're in cash, you're not losing money. It's always better than
True.
losing money.
This is true.
And
Okay.
this regime is notorious for losing money, whether you go long or short. So cash is the play and continues to be the play until we get a regime pivot. But yeah, let's take a look at next week. Next week is a shortened week. Don't forget that. Thursday markets are closed. Friday is a shortened trading day. So let's start off with Monday. We've got no market moving events. Tuesday, we've got Fed speaker. That's the only notable event. Wednesday is the big day. So we've got durable goods orders, jobless claims, PMI composite flash, new home sales, consumer sentiment, EIA petroleum status report, EIA natural gas report, and the FOMC minutes. Friday, we've got the Fed balance sheet.
So let's go over a recap of what happened in the last week. We had a few important economic indicators come out, and really they just signal that inflation, the effects of inflation are slowing, but they are not slow enough just yet. So let's start with PPI. The month over month readings came in under expectations. So we came in at 20 basis points on the headline figure. Um, but the year over year numbers still remain very high at 7.97%. And let's go to we have the core producer price index here. Excuse me, the United States core producer price index. This showing also signs of peaking, but the month over month readings are at zero now. So this is a little bit different than headline. Month over month at zero. It's one of the lowest, if not the lowest, month over month readings this year. But the year over year number again still very high, just as they are with headline figures. Now we had retail sales on a month over month basis come in at 1.3% increase. We're printing off the lows and climbing. This is not signaling that things are that distressed, at least not yet. We had the United States retail sales excluding autos. So this is core retail sales coming at 1.3% as well. Again, not signaling that things are as distressed. We had the United States crude oil stocks come in at negative 5.4 million. So I've adjusted the chart here from what you guys have normally seen. I went from a monthly chart because it is less conducive to understanding what's going on down to a weekly. And I also added the blue moving average for the crude stocks. And this is going to better help. This is going to help to better illustrate what I'm trying to tell you guys when I say it's not where the crude stocks are printing today, but it's where they are printing in clusters. So we use the moving average to give us an idea of where they're printing. So if we take a look at the blue line, the orange line that you see here, that's just the price of crude oil futures contracts. So the November print is slowly falling apart as we're seeing here at negative 5.4 million, but the average is still holding positive with the blue line, right? Now, this still is negative pressure for crude. As you see, crude's best rallies, or the time that crude performs the best, is when the moving average is under zero. When it gets above zero, when the moving average is above zero, it's negative pressure, and when it's below zero, it's supportive pressure. So most of this rally that we've seen in crude happens with the cluster of oil prints under zero. So we'll see how this moving average progresses going forward. But right now, still bearish pressure on crude prices until we see that flip. Let's go over building permits. These are printing lower as well, but they're not falling apart, just as not in the way that home sales are. And we'll talk about that in a minute. The rate of change figures are still in the negatives. Okay, so the rate of change down here is still in the negatives. We're not, we haven't rebounded just yet. So that's something to watch. Obviously, building permits are going to slow as rates are higher and cost to acquire capital rises with them. Let's go to jobless claims. Jobless claims came in at 222,000. Just another signal that the labor market remains tight. Nothing that is showing the signs of unemployment really hitting the market just yet. We've had major tech layoffs. Someone actually tweeted to us on Twitter saying that um, depending on the severance packages, they may not be eligible for unemployment, but uh, most states basically allow you to collect unemployment with a severance package. So the question really is are these people double employed or easily finding a second job where they can sidestep one job, maybe call it Twitter, right, into another company, or Facebook into another company, and not have to worry about the unemployment or jobless claims? Or are they just lackadaisy because they've gotten their severance package, and are those claims going to hit at a further date? That's really the question that's coming on, because everyone's seeing these job layoffs, but no one can really put a finger on what's happening here. And that's really what we have to wait and see, and how this bleeds into the these numbers in the future. Let's go over the Philadelphia Fed Manufacturing Index. This is a lower print, and this is falling apart compared to where it was earlier this year. And as you see here, this is the lowest print since the COVID crash. Just another indicator of the situation that's worsening, but again, not something that is um, deteriorating to the point where we are at 2009 lows or COVID lows. So just something to watch going forward here. We had existing home sales falling again. The year over year change is now printing negative 28%. So this is completely falling apart, and it continues to fall apart, and it shows no sign of stopping just yet. We are not at the COVID lows, but this is the lowest print since the COVID crash. We're not there yet, but we could easily be there in the next few prints, and then we're targeting the 2008 area. So let's move on. And before we go any further, I just want to mention that all the data that you see here and all the stuff that we talk about, it's all included on our website, updated every day. We talk about this stuff all the time in our private Discord. You can get access to all this stuff, hedge fund quality material, interactions with us and other people in the community for $24.99 a month. And also, let me mention, you also get access to our trading view indicator, so you can add that to your charts and see the trends as we see them. Again, it's $24.99 every month. But let's go to ES and let's see what happened this week. So, Artie, you want to take it from here?
Yeah, well, it was pretty uneventful, as many of you probably know. Um, we have been seeing strong fighting between bulls and bears. The bears think the market's gonna collapse. They hate this rally. You got the bulls calling for new all-time highs, Fed pivot, and what the market does is absolutely nothing and screws both of them over. And we'll have to see how it plays out next week. We're probably going to get a pretty slow week continuing into next week as well, just because of the shortened week. There's going to be low volume. So don't expect any crazy moves. We might see something occur on Wednesday with all the new data coming out. So that's the only day where we really see any potential moves occurring. But it's likely going to be an uneventful week. So if you're planning any options plays, not high hopes on those.
Yeah, yeah. I mean, given that the market has been able to hold higher, but not really go anywhere, is hurting a lot of people that are taking short-term positions. We do have a hedge expiring next week. We'll see how that trades out, and we'll talk about it in next week's podcast. But right now, obviously, the question is going to be: does the market do another batch sideways next week, or do we get some actual price movement into the holiday weekend? We're going to have to wait and see how that plays out. But as of right now, obviously, we're still above mid vamp, still above the Fed day range high, and the system is slowly building towards risk on. So it's kind of, even though it's bearish trend, it's kind of giving us the feeling that the market still has upside risk. So when you see us on Twitter say the market has short-term risk higher, that's because the system is telling us that much at the moment. The question is that risk higher going to resolve with a further move lower as we continue risk off, or are we going to actually have an official risk on pivot and go higher from there? Time will answer that question. Let's go to bonds.
So bonds, as we've stated in our podcast, I think it was maybe 3 weeks ago, we were stating that the risk to reward in bonds, in shorting bonds, is just not there anymore. And sure enough, we called the bottom. It was no freak accident. We do have models that help us with this. We're likely, whether or not bonds are a buy, for us, they're not a buy. They're bearish trend. We do not see deflation in the near horizon, which is what bonds need for a real rally. So we're likely going to get chop. That's the most likely outcome. If you
Yeah.
are trying to buy the lows in bonds, we definitely do not recommend that. It will potentially be dead capital, and you're going to be subject to choppiness, emotional strain. It's just not worth it.
Yeah, it's I guess recommend would be the wrong word to use. We wouldn't do it, right? I mean,
Yeah,
can't
we
really.
we
Yeah.
definitely would not do it.
Yeah.
We need it to be bullish trend at the very least. Bullish
Yeah.
trend to even think about it, and our system needs to be deflation as well. And we're getting
Yeah.
neither of those.
And that
And
and
so,
that's important though. I don't mean to cut you up, but that's important, right? Because the system has been building in risk on has been basically pricing in a risk on premium, right? Over the last month or so. So that's really what brought us out to say that listen, the odds of bonds going lower from here are not as what they used to be because as the system prices on risk on, it just means less favor for less favor for that bond trade, that reversal that everyone's looking for, which is going to happen when interest rates fall apart, right? If interest rates don't fall apart, the bond trade's not going to come to fruition. So if you're looking at bonds and you want to buy bonds, know that the biggest return on the bond trade is going to happen when the market starts pricing in excessive Fed cuts. That's when things start going in your favor, right? When the market and when the market price starts pricing it and the Fed is doing it, whatever, you get my point, right? When the terminal rate starts falling is when the bonds are going to do well. The terminal rate chopping in a 20 basis point range or, even a 50 basis point range for 6 months is shit for the bond trade.
right.
So we need that breakdown in the terminals to really get the bond trade moving. Now, if you look on the chart here, you can see we have the ZB bond futures Momo's all the way up at 143. We're at 125 right now. Meaning bonds can go to 143, which would put everyone on their ass and say, "Oh my god, the bond trade's been back. We missed the lows," right? But the bonds can go to 143 and then easily go back to 118. It's bearish trend still. So as we go back in time here and we can look just in June, right, of this year, bonds went from 130 all the way up to 145, or the bond futures, I should say, and proceeded to shit the bed aggressively, like in a straight line. You know how they say markets don't trade in a straight line? Well, bond futures did, right to the downside.
Right. Against all odds.
Against all odds, right? So like, what's to say bonds can't rally and then shit the bed again, right? We don't know what's going to happen here, which is why we have no confidence in telling you what we would do, because honestly, we're not doing anything because there's no signal to do anything. If
Right.
there was, we would have a position on. And
We
when there is, we will have a position on.
we stick to high conviction trades. Like
Yes.
our system has, I mean, I'm foreshadowing a little bit here because we will be releasing metrics on our system in the near future. Our system has over 30% compounded annual growth rate since 2004, and that's because we stick to high conviction trades. And this is
Yes.
just not a high conviction trade.
Yes.
So
Yes. And you know what
why
the
even
best
waste
part
money on it?
the best part about what you just said is we stick to high conviction trades, yet we don't come up with the trades.
Right. It's all the system, zero emotions involved.
Right. It's literally, we created the hierarchy for us to say to jump when it says how high. Or I should say when it says jump, excuse me, we say how high, right?
Right.
Like we created the signals and we just do what it says.
Right.
Now, we could listen, there is risk in this. This is not for everyone. Some people prefer stability. And I think that's where we can segue into like and talking about portfolio volatility, right? Because it's a great topic that everyone likes to talk about. And
Hmm.
this is where things are going to get a little bit interesting, right? Let's
Yeah.
just say we take hedge fund A, Bridgewater, any of these major funds, 100 plus billion under management, right? A daily variance in their portfolio, in their NAV of more than 1%, right, is more than $1 billion in day in fluctuation. Okay, think about this. Forget everything you've been taught about managing risk and everything. Just listen to me and understand what I'm about to tell you. 1% is $1 billion. $1 billion. Okay. Now, say you take an individual with $100 in his brokerage account and it fluctuates 1%. He's fluctuating $1, right? Now, if you wanted to make a lot of money, forget percentage of returns, right? Over time, let's call it 5 years, and you were minimizing your drawdowns or your average daily variance, to maybe a quarter of a percent, less than 25 basis points, right? But you were hindering your gains. Okay. So you're hindering your gains. You're chopping the shit out of your CAGR. Remember, CAGR is compounded annual growth rate. So over a period of time, what percentage is compounded annually, on average, compounded on average annually to get to the end result. So you chop the shit out of your CAGR, which means you kill the growth, right? To say that your portfolio only fluctuated 25 cents a day, right?
Right.
Meanwhile, a big fund that manages 100 plus billion, right? They may chop their CAGR might be shit. It might be, the SPY's CAGR is anywhere from like 7 to 8%, right? Since 2004, 2005. They may be running a 5% CAGR, right?
Hmm.
But, and their daily variance might be super small, like 25 basis points,
Yeah.
right?
So they're prioritizing on smaller fluctuations and they're sacrificing some gains
Right.
because
But
they're
hear me
managing
out.
so much money.
Yes, exactly. But hear me out. So let's just say 5 years goes by, or 1 year goes by, right? And we'll just use it to be simple, 5%, right? You made $5 on your $100 account. They made $5 billion,
Yeah.
which again, they're incentivized to follow this fuck street program of reducing your portfolio volatility to make you feel safe. The markets are not fucking safe. Okay, this is the streets. Literally. FTX went to fucking zero.
Yeah.
FTX pulled a Dan fucking Pena.
Hmm.
All right? Zero. Went to zero. Right? Money gone. Evaporated. Fairy dust. Right?
Yeah.
FTX is on fucking sports arenas. It was on the MLB jerseys at the World Series. Think about that. Zero. thing's a fraud, right? So like to sit here and say like, yeah, okay, I want to reduce your risk. That's the game. You want to know why you have to reduce risk and hedge funds have to reduce risk because they're running pension money. They're running retirement money. You can't fuck that up. You can't. And you know what? And some of them still do. But you can't fuck up pension money. You got people, you got teachers, you got public service work, you got public workers that are, mailmen, whatever, that are working their jobs 9 to 5, and they have this guaranteed pension, right? They need this money. They're promised this money contractually. So you can't fuck it up.
Yeah.
But
But
if
why
you take
why would an individual investor who's managing a few $1,000s follow these same metrics that these hedge funds are following,
exactly, it's
managing
bullshit.
billions of dollars?
It's bullshit. And what ends up happening is you have these big media firms, these big institutions, right? Well, I should say these large institutions, big institutions I would consider like BlackRock, right? These big, large financial media companies. That's where I'll leave it at. That are basically looking for the big bucks, right? They want institutional clients. I could give a fuck less about an institutional client, which is why I'm able to say the shit that I'm able to say. We don't get ad money. We don't cater to institutions. I don't have to report to $1 million or multi-million-dollar producing clients, that I've signed contracts for. Can't say this, can't say that. That's the best part about this. That's why this is great, because I can tell you exactly how it works. Literally, these people are going to make strategies. These funds they're out there. I'm not going to name any of them that sell these reports or these daily shows or whatever, right? These newsletters, right? Oh, look at our macro fucking fairy tale dust bullshit, right? Like, yeah, okay. They're selling you a program that they are going to take that same program, build off of it, put some more bullshit under it, and sell it to an institution for about $5,000 a year. Okay. That's what they're doing. And no institution is going to buy something as crazy as what we are doing here. But that's okay, because I don't need institutional money. That's
Yeah,
the best part. Like I
we
said,
we don't make this for institutions. We make this
yes,
for the everyday regular person managing a few $1,000s. You don't want to make
right.
2-3% a year on a few $1,000s. We're here to go balls deep in TMF, go leveraged. This is what we do, and we have minimal drawdowns because of the system. We have high conviction, so why not leverage? Leverage is your friend if you know how to use it. And that's
Yeah.
exactly what we do.
And I will say something right now. And I know Warren Buffett has said this a lot about, he's criticized leverage. Yes, I understand that. I know many people have come to me and say, oh, Warren Buffett, the guy says, yeah, if you're not smart and you'll have, oh, that's fucking stupid shit, right? Nonsense. Listen, let me understand this. Warren Buffett also has said, you're better off putting your money in SPY because most people cannot consistently outperform, right? And I'll tell you this. Within 5 years from today's date, okay, if we are not beating SPY considerably, we will no longer be here because we see ourselves of no service. It's that simple. If we cannot beat SPY, we have no value. Because at that point, I'd be doing everyone a disservice. And that's not what I'm here to do. So if we can't beat SPY, you won't hear from us. But I can tell you that I can beat SPY because I've done it.
And not only beat it, crush it.
Yeah, I know.
Completely crush it. You guys will see the
Well,
metrics.
yeah, you'll
Um,
see. You'll see what happens in real life. Like even the metrics. Fuck the metrics. Well, we'll talk about it, but fuck that. Wait until we go into the game, like real time, because that's what matters. I could have sat here since day one and showed you guys these big data points, gone down trainer ratios, Sorrentino sharps, fucking smart sharp, whatever the smart Sorrentinos, whatever the fuck you want to, skews, all this shit. That does not matter. You want to know why? Because this is the problem with portfolio volatility and my drawdowns, right? Listen, the system running since 2004 has on a leverage 3x has a smaller drawdown than SPY. And we'll go over that again at a later date, but that's all you need to know right now. Okay? Simple. Right? 3 times leverage, less drawdown than SPY.
less drawdown and 30% annual compounded growth
Right.
rate.
But before I go any further, just remember the portfolio volatility does not matter none of this shit matters in the end as long as you don't blow up in the process. Hear me out. If I told you, the Sharps, the volatility adjusted return, for those that don't understand what that is, you don't need to know anything else, but just understand the metric is measuring the volatility within the portfolio and like your excess returns, right? So if you have a super sick Sharp, but your end result is nonsense, what does it matter? The answer the institutions will tell you, you can put more money behind it. Look, I can put millions behind it. Super low volatility, super low risk, decent return. I can put millions behind it and make a lot of money in the end. Problem is you don't got fucking millions. You got maybe a couple grand in your trading account. So what good is it if you can't put money behind it, which most people cannot do? Most people cannot put money behind these super glassified or magnified, right? Like, oh wow, look at this trading strategy that works so well. But yeah, you only have your money, right?
Mm-hmm.
So at the end of the day, again, we both start with zero, or we'll say no, we don't start with zero. We start with $1 each, right? In 10 years, I have $20 or I have $10 and you have $3, right? Here, in this example, my drawdowns, right? Again, 3 times leverage are not as bad as SPY. Okay. Your drawdowns on SPY are what SPY is, right? And you would look at me and say my volatility, which I'm able to accept, I don't care about 10% price swings. It doesn't matter to me, but that's my thing. Again, you have to do your thing. For me, don't matter. I don't give a shit. Okay. At the end of the day, it's the number at the end that matters, because in this whole thing of like running through the fence, running through your ideas of saying like, oh yeah, look, I can build a stable growth. Yeah. Okay. Do you want $1 million when you're fucking 60? Think about it. Do you
Right.
want to sit here and have a shit ton of money down the road? Because that's the difference here. And again, this is not financial advice to tell you what you should or shouldn't do. SPY makes sense for people. Just buying the market, going to a financial advisor makes sense for people. It's fine for those individuals, but it's not for me. This podcast is not to tell you what to do with your money. It doesn't matter what you do with your money. Okay? To me, I'm not your financial advisor. But what I can tell you is from my perspective, no financial advisor could ever do for me what I could do for myself, because every financial advisor has one interest in mind. It is not your money. It is not to even make them money. It's to protect themselves from you losing money. Because here's the secret: financial advisors don't give a shit about you making money. They only care about you losing money, because that's when the problems arise. If
Right.
they make you
That's when they get
1%,
sued and they have to deal with
yep,
bullshit.
yeah, if they make 1% a year, they'll just lose assets, right? No big deal. But if they lose you 30%, 40%, that's when the old fucking comes. And that's the biggest thing that they're concerned about, losing clients' money. Because again, they don't actually care about losing you money. They care about what you're going to do when you find out they lost you money. And I think that's where we're going to wrap this podcast up this week. Stay tuned for our podcast next week. And thank you guys so much for watching. If you like this podcast, please like and comment below. You can find us on Twitter at The Market Radar, and our website is www.market-radar.com.